So before we start, I just wanted to give you a brief overview of what we have in store for you. I will take you through the short journey that we've had in the last 1 year, and then I'll hand it over to the fund management team to take you through how they have put the two funds together and our progress in the last 1 year. And then we have an interesting discussion on asset allocation, followed by Q&A. Before I get started, I just wanted to invite Mr. Sarath Reddy, the co-founder and CIO of Unifi Capital, and he's also chairman of the asset management company, to say a few words before we start the presentation.
Thank you, George. Good morning to all our distinguished guests and colleagues. When we began this journey, it was almost 4 years ago, and it took us 3 years to finally get started. It's been a year, and so here we are. But those first 3 years, when we were trying to conceptualize the fund, we met a lot of people, experts in the industry. We did as much reading as we could. And I learned two things that have helped, in some sense, define the path we want to follow. One of that came from an observation of the industry. I wasn't aware that there are 2,000 mutual fund schemes in the industry and over 50 fund houses. So the first question, in fact, when I mentioned this to my wife at home, and she asked me this, why are you getting into something where there are already 2,000 schemes and over 50 fund houses? And we asked ourselves, how do we make a difference? The world didn't need one more scheme or one more fund house. And the journey we've decided to follow is based on that reflection. We promised you a year ago when we started that we would only launch 2 schemes other than the liquid fund, and that's what we've done. George wants to launch one more scheme. The 2 that we've launched is one for equity, one for fixed income, and one for a hybrid that he has in the works. But the fixed income and the equity approach that we've taken are very distinctive. Our fixed income is based on 13 years of work the same team has done, Saravanan and his colleagues have done, on the AIF platform that we did over 75 transactions, diligenced companies bottom up, visited branches of companies, understood their technology, understood what alternative finance was doing. And that bottom-up understanding is the foundation on which we are building the DAF fund. It's truly distinctive because it gives us the conviction that comes from years of understanding and experience. If you look at what our Flexi Cap is, our Flexi Cap is no different from 40 other Flexi Caps in the market. But there's one difference. Unifi Capital, the sponsor, has been doing this for 25 years. We've been through cycles after cycles. And it's that understanding of cycles, that understanding of the businesses, the people who run those businesses, that this team brings into its work in the mutual fund. The idea was, if we do just 2 schemes, we'll be able to put our best foot forward, conserve all our energies and focus them on just those 2 funds. And hopefully, that will show up in performance. Some of you would have noticed, and I'm happy to share, that at the end of the first year, both funds are in their top quartile of their categories. Both have done very well. We are delighted. And the focus is now, how are we going to sustain this? There are two approaches to sustaining something. One is the day-to-day grind of making sure that we are doing our diligence properly, managing risk properly. The other is recognizing the realities to some extent. The fund management industry, there is an inverse relationship in many sectors of the fund management industry between scale and performance. There is a desire to grow. We also would like to grow. But if growth comes at the cost of performance, then it becomes counterproductive. At what point will we say no to more money? That's a promise that I want to make on behalf of my team to you. Growth is not the purpose. Performance is the purpose. And we will stop taking money in both our funds when we think we've reached an optimal size. And the whole purpose of that is to prioritize performance over scale. It's not our growth, it's your performance. That's the priority. The second learning that we've had came from something that surprised me. I believe only 20% of equity investors in mutual funds in India stay 5 years or longer. And when we looked at developed markets, we read that it's not the case, partly because in developed markets, a lot of equity investment actually comes in through retirement accounts, which tend to be longer term. But even if you set aside retirement accounts, what I'm told by experts is that investor education has been the single biggest driver of increasing length of stay of an investor. I looked at our own experience in Unifi Capital. Over 25 years, our data shows we've retained our clients, more than 80% of our clients, for 5 years or longer, in good cycles, and in difficult cycles where our own performance went through difficulties, we've still retained them for 60% of our clients for 5 years or longer. And we tried to rationalize, why is it different? Why is Unifi Capital able to retain 60% to 80% for 5 years or longer? And that's not the case with mutual funds. And this morning's event was partly conceptualized based on our understanding of what it takes to what they call investor education. If I have to sum it up, my learning of what investor education seems to mean is two things. One is you have to get your asset allocation right. And that's why George has scheduled this discussion with Maran. If you get your asset allocation right, then you have peace of mind and you stay the course. The second thing is what we are trying to do is to share with you today and through all the interactions that we have in mind that the length of stay, longer the length of your stay, lower your risk in terms of your exposure to the cycle. All of us know equities are cyclical. How do you, without having to predict the leg of the cycle in which you're coming into the market, how do you mitigate the risk of the cycle? The only way is to think a little longer term. There was a conversation Maran and I had with one of our clients several years ago. This gentleman is easily India's largest, most reputed, most successful investor. We're fortunate to count him as a client. Maran asked him, sir, according to you, what is long term? In a second, he said 15 years. He didn't think, he said 15 years. And we've thought about it time and again. That runs through my mind all the time. And when you look at the course of cycles in India, you look at the up cycle and the down cycle. The up cycle always takes more time. The down cycle is always much quicker. Not just in India, everywhere. The down cycle is full of fear, so it's accelerated. But the full course of the up and down leg is usually 15 years plus minus a couple of years. So if I asked our investors, stay 15 years, it's a hard sell. It's difficult for people to think 15 years. But if I ask investors to stay 5 years, I think that's reasonable. Most people in our country now are comfortable with that number. And that's the whole purpose of this morning's interaction. To be able to get you to understand the team that works for you and the value system, the philosophy with which we work. And hopefully that will give you the comfort to stay that 5 years and easily mitigate the risks. The journey will have lots of uncertainties, lots of events, lots of wars, and acts of God, acts of man. But if you know that we are on the job and we are managing risk and we'll see it through, then you focus on what you do, your profession, and leave this to us. And 5 years will pass and your outcomes will be respectable. With that, I'd like to welcome all of you and thank you. Handing it over to George.
Thank you, Sarath. I think you've made my job a little easier because you've covered a lot of the stuff that I want to say. So I'll make my presentation shorter. I just want to take a few minutes to take you through the journey of Unifi Capital and some key highlights in our last 1 year. The mutual fund is a 100% subsidiary of the parent company, Unifi Capital. And so we have the mutual fund license. Unifi Capital, which is the parent, has the PMS and the AIF license. Unifi Investment Managers, which is the GIFT City entity, has the international business. And to support all these businesses, you have Unifi Research Analysts, where all the analysts sit. Unifi is one of India's largest investment managers. The AUM as of 31st March was about 21,400 crores. We have about 166 employees. Out of the 166, about 33 are from the mutual fund. And as Sarath mentioned, we are 100% employee owned. And we put the performance of the portfolio right in front and not growth and profit of the AMC. We have offices across the country, and soon the AMC will also expand into most of these cities. Here I just want to take you through the last 1.5 year journey of the mutual fund. We got the in-principle approval from SEBI in November of 23, and in exactly a year, we were able to get the SEBI license to start operations. And in a few months, in March of 25, we launched our first scheme, which was under the dynamic asset allocation category. Then followed that up in a couple of months with our maiden equity fund under the Flexi Cap category, and also a liquid fund. And between the two funds during the NFO, with a lot of support from the parent company, we collected about 600 odd crores. And I'm happy to announce that as of April of 2026, we have crossed about 1,500 crores. And thank you. And as Sarath mentioned, we have two mainstream funds on the platform now, and a third is in the works. Hopefully, we'll have that ready within this financial year. So actually, this is the part I said Sarath has made my speech a little easier, because this is what he just spoke. So even before we applied for the license, I'm sure there was a lot of, even before I joined the firm, there was a lot of discussion within the sponsors. And then subsequently, once the board was formed, the board also discussed. And there were two thoughts. One was they analyzed the market. And as Sarath mentioned, there were 40 odd AMCs, 2,000 odd schemes. Hence, for a common investor to pick the right fund, whether be it equity or fixed income or hybrid, it became extremely difficult. So with that aside, and then we looked at what is the strength of Unifi Capital. And for the last 25 years, they've been extremely selective they launch. And they've been successful in launching schemes that they think brings a unique proposition to the table. And when they align that with the customer's expectation, then there is a match, because customers tend to stick with the fund. Unifi Capital is putting all the efforts into few of the funds that they've launched, and hence in the long term, there is a match between the fund performance and the investor's expectation. So these are the two things that actually kind of aligned, and even for the mutual fund, we will make sure that we align these two. And there are about 6 boxes, and it kind of summarizes all that Sarath mentioned. I'll just probably add 1 or 2 points. Unifi Capital has always been an active fund manager, so the chances of us venturing into the passive side is highly unlikely. Again, we want to make sure that the products we built are purposeful. There is a clear investor expectation and return profile that we will indicate. The other aspect of, I was in wealth management for almost 20 years, and I found it difficult to pick funds that kind of go across market cycles and themes. So hence, we want to make sure that the schemes we launch are compatible across market cycles. It doesn't come with certain themes that go in and out, so the investor can stay with it for the time that they want. And Sarath said 5 years is our target, and if we can get there, I think we count ourselves successful. And in this day and age of SIFs, AIFs, things are getting more and more complicated for investors. So for our idea is to make sure that the products that we put on the table are as simple as possible, easy to communicate, and for the fact that people tend to exit funds at the long time for not getting the right information, we want to make sure that we communicate on a regular basis. So there are a lot of initiatives we've put in place. Apart from the usual monthly fact sheet, we have a quarterly update from the fund management team, which just waits for the quarterly results to come out, and then we communicate. In addition to that, there's also an initiative to come out with a video fact sheet. I think in this day and age when the mental bandwidth of people to read has come down, we think a digital fact sheet or a video fact sheet could help. And lastly, we want to make sure that we launch products where the parent has core competency in, and that thereby we are not venturing into areas where we don't have confidence or we don't have expertise. So this, kind of in a nutshell, is what just Sarath mentioned, that and we will make sure that we stick to these principles. So before I close, I just wanted to take a few minutes to take you through some of the key insights of our AMC's journey in the last 1 year. The two pie charts on the left side are the start of the two funds, the DAF and the Flexi. As you can see, as we started, there was a lot of dependence on the promoter and employees to get the funds. We didn't do any sort of marketing. But also what helped was, because of the legacy that Unifi Capital has built for the last 25 years, we were able to get some of their clients to come in through the direct channel. And it was not a conscious effort to chase direct. It just so happened that initially, since we didn't market the product, we didn't have the time to market, the initial support came from direct clients who knew Unifi Capital, and the promoter and the employees also started to put in. So that was the journey of DAF. So we collected about 500 crores. It was equally supported by the direct investors and promoters. However, the Flexi was slightly different journey, which happened a couple of months later. Because of the long-term relationship Unifi Capital had with some of the distributors, a few of the distributors supported us, and we are extremely thankful to them for giving us the chance to exhibit our maiden Flexi Cap Fund. So there, as you see, close to 45% has come from RIAs and distributors, and about 44% again came from a combination of promoters and employees. And the direct investors of 11 was just a few known investors who supported us, again, direct investors. From then, if you fast forward to June of 26, the pie chart looks completely different. The DAF and Flexi have gained traction. What was absolutely zero in terms of support from distributors and RIA and DAF is now grown to a pie of about 31%. The promoters and the employees' money stays because that's part of our long-term allocation, even though that is not part of skin in the game as per SEBI's requirement, we will make sure that that money stays, and that forms the core part of the portfolio. And as you can see in Flexi, we've again doubled our AUM from about 108 crores to 200 crores. This is as of June. The data is even higher now. Again, the percentage percentage of contribution from distributors of RIA has also gone up. It's almost 62%. So thereby, we are very clear that we are not just focused on direct or distributor. We are willing to work with partners who are okay to kind of come along with the journey that we mentioned. And along that, if direct clients come, that also is going to be a plus. So it's going to be a combination. So we don't have any sort of affinity to one set of investors. The table on the top right-hand corner shows the number of folios we had at the start. It was about 1,600. That's now grown to about 7,000. The number of SIPs was about 195. That's grown to about 1,500. And the last table in my introduction will be on how we built up the team. As you know, the AMC business is about putting the infrastructure in place in the beginning, and then the AUMs come later. So we had about 25 people to start with, predominantly on across all the functions, the fund management, sales, operations, and tech and compliance. And that number has grown to about 33 as of now. I think with this number, we are staffed for at least 1.5 years of growth. And then as the AUM grows, what will grow will be the number of people in the fund management, sales, and customer service. So with that, I come to the conclusion of my presentation. As I mentioned, we have 3 more sessions. Saravanan, the CIO, is going to take us through the dynamic asset allocation fund and also give his views on fixed income, because the fund is predominantly a fixed income structure. And then I'll have Aejas Lakhani, the equity fund manager, present our Flexi Cap Fund. And then, as I said, we'll end the session with an asset allocation discussion, which I will explain after these 2 presentations. Over to you, Saravanan. Yeah. Also, just wanted to mention there is a QR code that we will show on the screen. If you scan that, you will get today's program, a little write-up from the 2 fund managers, and also the latest fact sheet. And this is something that I said we will keep repeating every quarter. So this was one that we wrote just for the event, and you will have the Q1 quarterly.
Am I audible? Yeah, thank you. Dear unit holders, distribution partners, well-wishers, and colleagues, a very good morning to all of you. For those of you who don't know me, my name is Saravanan. I serve as the Chief Investment Officer at Unifi Mutual Fund. And I spent last 20 years in Unifi. I've been fortunate to be part of its growth journey. In its equity research division, debt and arbitrage division, as well as I had the opportunity to seed the debt practice and launch a CAT 3 alternate investment fund in April 2013, which we ran it for 12 years before we cut over to the mutual fund segment. So yeah, and thank you for taking the time out on a Saturday morning. Sports, sleep, or a leisurely brunch, or even family time could be a serious competition. So we really value that you have taken time off and come here to listen to us. And as a young mutual fund, so your support has meant a lot. You've been part of our journey from the very beginning. We are conscious of that responsibility, and thank you once again for placing your trust in us. So this is the standard disclosure. So I just want to call your attention to the riskometer. So we are categorized as moderately high risk, and benchmarks, we have two benchmarks, tier 1 and tier 2. They are categorized as high risk and moderate risk. And product suitability we have disclosed. If you have any queries, you can contact your financial advisor, or you can also reach out to us. So there are some, I see some young investors and new investors, and even as new out, should we focus on growth that comes with volatility? So the answer is, it's always a combination of both, taking into account your context, right? But for the young investors, I just wanted to show you an interesting slide which talks about two portfolio performance. Portfolio A is a stable portfolio, not much volatility, very low standard deviation. And then you have portfolio B, which is done substantially better than the portfolio A in 4+ years, and in 4 years, and in 1 year it's underperformed. And but the returns have been substantially higher in portfolio A in the last in the 4 years. If you see the outcome, you will get the answer whether stability compounds better or growth with volatility compounds better. But there is a caveat. This works if it's for a shorter tenor. The tenor that we're talking about is, let's say, 2 years, 3 years, 5 years. So the answer to the new investors, the queries from new investors which we often get, whether we should be focused on growth or we should focus on stability, for any of your financial goals that are falling in the short to mid term, it always makes sense to go for the stability. So that my whole intention was to highlight that. If you see here, see, 1 year of volatility has caused a massive drop in the NAV in year 3, and even on year 5, the NAV has not crossed the stability portfolio. So even when you meet your advisors, they will also recommend you to have a allocation that suits your requirements, suits your age profile, suits your risk profile. And I told you, like, stable allocation works for the short term, but for the long term, equities make you most of the money. As our founder as well as George told you, the time in the market is very, very important than timing the market. So you would see that equities have done substantially well. See the average returns of the categories. This is the last 20 years return. So if you see, the average returns of equities have been 14 to 20% on a CAGR basis, but they've come with a huge volatility. But whereas debt categories have given you moderate returns, but at a substantial lower volatility. And the difference is between 4x and 40x. A debt category has, multiplied your money by 4 times, whereas with equities, you had the opportunity to multiply 40 times. So again, that's why we have launched both the propositions. If you're stability oriented, we have our dynamic asset allocation fund, and for your growth portion of your allocation, we have our Flexi Cap Fund. So coming to our fund, the objective is to deliver across cycles, and the focus here would be capital preservation, maintaining the liquidity profile. We understand it's a debt allocation and there could be exigencies, so we are maintaining the liquidity profile. That's the whole focus. So for that, we have identified 3 segments of debt and equity. The name would tell you that we have the flexibility to be very dynamic, right? It's called dynamic asset allocation fund, which means we can have 0 to 100 in equity or 0 to 100 in debt. And we have chosen to use the dynamic ability to create stability in your portfolio. We can also choose to create growth in your portfolio, but which most of our peers are doing, but we have chosen this category specifically to create stability. There's nothing wrong in either of the approaches, because we have decided to launch limited schemes, and we are only focusing on providing propositions. So the growth proposition is solved by our Flexi Cap. So stability proposition, we found this vehicle also to be tax efficient. So it's a combination of all these 4 factors. Any fixed income investor looks for stability, liquidity, and tax efficiency. So this particular category provides us the opportunity to meet the requirements of a fixed investor. So the 3 categories, subcategories of debt and equity that we have identified is highly rated debt, which is high quality and highly liquid also, that provides, occasionally it provides us the duration optionality, if at all we want to participate in that. And the second category, where we have more than 15 years of experience, focusing on bottom-up high yield credits, where our strength comes to the foray, where we meet the companies, do the due diligence, and then take a short-term view. So when I mean credits here, it's typically less than 2 years, and that too it follows an amortization structure. So the liquidity profile is not compromised. And then for the tax efficiency, we've included the low volatile equity in, segments, because we've again told you it's a stability oriented fund. So if you see the equity segments, cash futures is as good as a liquid or a fixed income segment. And in order to spice up the returns, we have introduced special situations, in which also the group has more than 25 years of experience. The group has done more than 400 plus special situations, and I've been part of 20 years of that journey. So that's a relatively safe category. It is definitely safer than pure equities, and it has very low volatility, and we are very excited about having that category in this fund. And you would see that our allocation is not going to be static. We have given you a range, and what can cause our allocations to move. So there are so many macroeconomic variables, but finally everything collapses into growth and inflation. So the growth and inflation outlook guides us to whether to introduce credits or to maintain a 1/3 allocation to credits, which is the maximum that we would like to maintain. So I'll just spend a few minutes on our growth and inflation outlook and how we see it, and then move on to the fund performance. See, growth, inflation, you can broadly bucket it into 4 segments: growth rising, inflation rising, growth rising, inflation falling, growth falling and inflation rising, and again growth falling and inflation falling. See, the second quadrant is the best for the corporates, right? Think about it, right? The top line is growing, and because of the low inflation, their margins are also growing. So that's the best time, if at all you want to have credits in your portfolio, that's the best time to infuse credits. And rising growth, rising inflation continues to be a good segment for the corporates, especially corporates with pricing power, because they are able to pass on the price rise and also maintain their top line growth. So even those 2 quadrants, even that's a good quadrant to be in for credits, as long as your companies are able to pass on the price rise. But in a falling growth environment, falling growth and rising inflation is the most difficult environment for a corporate. So in that segment, if we feel we are getting into a stagflationary environment, we have the complete flexibility to cut down on credit. We are not going to be mechanical about it, because we have mentioned and we have to generate high yield, we will infuse credits. So we will be quite circumspect to infuse credit and increase the allocation. So we will definitely avoid credits in the stagflationary environment. And in the 4th quadrant is when RBI will get into, and government will get into regulatory steps to infuse growth and some bit of duration, if at all we want to play, and in a limited way we could play in the 4th quadrant. So this is how our asset allocation would be determined. So we are dynamic in that sense. Between debt and equity category, it's going to be 65-35, because that's what gets us the tax efficiency. But within the categories of debt and within the categories of low volatile equity, we are going to be fairly dynamic. So this is the growth inflation journey for the last 20 years. You would see that the scenarios that I mentioned has played out. So 2006 to 2009, and was a high growth, high inflation, followed by subprime, which resulted in low growth, high inflation. And then there were domestic policy reforms, and oil prices fell, and the FRBM, the Fiscal Responsibility Act, was passed and adhered to. So that resulted in a phase of high growth, low inflation, followed by again COVID, where we had again low growth, high inflation, and again followed by a high growth phase and low inflation. So this is how last 20 years have panned out. If we were to roll it forward, what is our current view? We feel the growth momentum is going to be sustained, and inflation on a short term basis, it may rise, but it will definitely be within the tolerance limit for the RBI, and RBI's mandate is very clear. They look at price stability first and only then the growth. So RBI, we expect RBI to act if inflation gets ahead of the tolerance band. And quickly on the macros which support our growth sustainability, and you would see this is a lot of data, but I'm just pointing you to what is in our control. See, our core, our domestic core has been resilient. See the GST collections, even after the GST cuts, on a month-on-month basis, we see that GST collections are only rising. In fact, June month collections, even the net collections are up 11% year on year. This is after factoring in the GST rationalization in last September. So the domestic structural story is intact. Yes, we have emerging global headwinds through crude, currency volatility, and balance of payments going negative last year, but we feel they are all temporary. India is a huge market and huge talent pool, and the demographics cannot be ignored, and we are in the right path where we are transitioning from a services, purely a services economy into services plus manufacturing economy. So that leaves us in good stead from a growth perspective. So even our positioning is growth plus moderate inflation at this point in time. And this is the yield curve movement that is very specific to the period where we have run the fund. We've seen 10-year GSECs start from 6.8, drop all the way to 6.25, and then move to 7, and as we speak it's back to 6.7 level. So it's been quite a topsy-turvy journey, but for us the whole point is cut down volatility. So we have chosen not to participate in the duration play, and we are more accrual focused, and since we have a healthy mix of credits, we are able to generate meaningful returns even at operating at a low duration. And NFO, we raised about 520 crores. As we speak, we are at 1,290 crores, and about 63% in debt and balance in equity and cash. And coming to performance, so the heartening fact is the standard deviation, but I'll just run you through the performance number. On a since inception basis, we have broadly completed about 16 months. So we are running at a 8.27% in the direct plan and 7.63% in regular plan. This is as of 30th June 2026. And the standard deviation is far lesser than the debt categories. Debt categories, if you take any category of debt mutual fund, they operate at 2%, and we are well below that also. And even from a financial year perspective, we had delivered meaningful returns. The weight for us, although I showed you a couple of benchmarks, tier 1 and tier 2 benchmark, if you ask us, the real benchmark for a fixed income investor is core inflation and the taxation. So post tax and post inflation, if you are left with some meaningful real returns, then we've added value. So we would recommend you to measure us with how much we are able to perform over the rate of core inflation, which incidentally over the last 12 months has trended at around 4.3%. And we are showing a monthly journey also, and touch wood, so far we have not had a negative month, and the volatility, the low volatility profile of the fund is established through this slide. So if you take another question we keep asking is whether we do lump sum or we do an SIP or should we time in this fund. The beauty is we are giving you absolute, it's a simple product from that sense. You don't have to time it, you don't have to worry whether it's lump sum or SIP or whether you need to focus on certain quarters. Nothing, even on a quarterly basis there's hardly any volatility. Monthly basis, yes, there could be some volatility, but from a yearly basis and from a 2-year basis, we don't expect much volatility because our portfolio duration is 2 years. So if any investor staying invested for 2 years, even if there is a intervening mark to market volatility, that gets recouped. So a 2-year journey for any investor should broadly be the same. And in terms of segmentation, in the credits, we are focusing on retail oriented NBFCs. That's where we have had the maximum track record. As our founder said, we have done more than 75 plus transactions, and we have onboarded about 33 plus companies to the mutual fund universe. The sum total, the balance sheet size of these 33 companies is more than 2 lakh crores, and we are hardly 0.5%. Our exposure is hardly 0.5%. Even if we go to 1%, we will still be a marginal lender to the to these credits. So the retail-oriented NBFCs have had a good run in the last 20 years, and it is it is fulfilling the requirements of all the stakeholders. For the government and RBI, they are solving the last mile credit delivery and democratization of credits. For the borrowers, they are the lowest cost institutional lenders, and equity investors are getting a decent ROA and ROE, and the debt investors are getting a yield. So it makes sense from all the stakeholders of the segments. So we are very excited to be in this segment, and within this segment again we have the flexibility to be more with secured players, housing and vehicles, if we see some down cycle in the economy. And broadly our quality allocations is again fairly diversified. And the credit, just a small bit on our credit evaluation framework, and this is common for debt and equity. So that's why it is quite synergistic for us. So primarily we are underwriting the people behind the company, the promoters, the quality of the executive team, the track record, and the directors, auditors, and we are also underwriting the processes and culture that they follow. And more importantly, we have to be convinced about the sector prospects and the company's ability to capitalize the sector prospects and become a meaningful player. So the focus remains here, and in addition to that, we ensure that at the time of entry, the companies operate at a high capital adequacy, have turned profitable, have raised meaningful equity, and have private equity investors on their board, because that's also a lot of governance process and MIS related requirements. And we have at the term sheet level, we have protective covenants linked to the ratings, profitability, management change, and so on. So that's what gives us the conviction, because one of the questions we keep asked is, why are you introducing credits in an open-ended platform? So these are all short-term credits with an amortizing structure, and hence low duration, and we are a marginal lender. And the biggest learning for us, if you ask me what has been, you have done fixed income for 15 years, what's the learning? We have to get the equity right. So that's why I said it's synergistic. Even when we analyze or discuss about an investment, we bring in the equity team also, because if you get the equity right of the company, if the equity attractiveness of a business stays intact, the debt holders are always safe. So that we have followed religiously, in addition to having the protective covenants. So we are trying to complete the bottom up review with a wholesome lens. So that's the key value addition we are bringing in the credit portfolio. And special situations, as I told you, we have 25 years experience, and even in the last 1 year we've had good open offers, IPOs, and some some unusual situations like a preference share where there was a discernible gap between the redemption yield and the entry yield. So we are capitalizing that, and again you would see that we have not participated in every offer or every IPO. There is a allocation, there is a way we evaluate these opportunities. One, if it's meaningful and it gives us a probability of getting that high probability of getting that return, only then we participate. So it's not again a mechanical allocation here. And this would show you how on a quarterly basis we have fairly been dynamic between quality and credit. We have not not hesitated to move among these two segments, again taking into account the sector or segment specific risk reward as well as the macroeconomic growth inflation. So at this point in time, we are broadly where we want to be. You would see 1/3 allocation in almost all the segments, and the YTMs are also at a healthy 10% rate with duration close to 1.5. And if at all we want to have a duration, add duration, our band is we would be below 3 years. We wouldn't want to cross more than 3 years. So that's the band that we have allocated for duration. And in terms of returns, you would see the returns have come from all the segments, and it's mostly accrual and very less capital gain. So that's one of our requirements. In the bond category, we would rather get all the returns from accruals rather than a one-time capital gain or frequently, trading related capital gain. So 57% allocation has been in the debt segment. That's given us 63% returns because debt segment operates at a higher YTM, and the low volatile equity segments have given us about 7.7. But the thing to highlight here is the arbitrage category has delivered about 6.5 to 6.8, and we've done 100 bips more than that because of our infusion of special situations in this portfolio. So special situations is definitely working for us. And this you would find it in the fact sheet. In the year 1, been fortunate enough to beat the tier 1 and tier 2 in the direct plan. But the most important thing is, as I told you, tier 1 is not relevant for us because it has open equity and we don't take open equity risk. So tier 2 and core inflation continue to be the relevant benchmarks. And this would, again, it's part of the fact sheet. You will see a fairly linear line, and in comparison to a tier 1 benchmark which has open equity, so it'll show you a volatile journey. And this is the real returns that I spoke to you about. So the real returns is very key in a fixed income option. So the hybrid category lets us deliver this. We have given it's not our performance, we've just taken a industry performance, but just to show where we can add value on a post-tax basis, post-tax and post-inflation basis. You would find that all the other categories are suboptimal. Only the hybrid categories, we have a realistic chance of delivering real returns. And lastly, about the risk. So the key risk, most of you would have gauged by now. The key risk is here maybe credit and liquidity. I explained to you how our approach about bottom up, and we are handling it in multiple ways. So we have position sizing, we have sector sizing, and we are also addressing it through addressing it through how much of credit and special situations this portfolio could absorb. So in fact, there is a clarity among all stakeholders that this product should not be scaled up beyond 5,000 crores. As I told you, the pre-approved universe, the balance sheet size is 2 lakh crores. So even if we do 1% of that, it's a 2,000 crore credit book that we can comfortably manage without even have to seeking new ideas. So keeping credit at 2,000, which is 1/3. So if you work back, you would get a AUM of 5,000 crores. We can comfortably manage without diluting the proposition, because we are trying to optimize, as I told you, returns and volatility. So 5,000 crores is a good number. So this is not a scale oriented product for us. This is a very strategic product for us, and I wanted to leave you this thought. So our credit, again, we will not force ourselves to pursue credit at any cost. We will be very circumspect about it. And the other one, you could ask us, what about the liquidity? You're running a daily open-ended fund. And my answer is, see, 70% of the portfolio, 1/3 allocation to cash futures arbitrage and 1/3 allocation to G-Secs and AAA, you have a daily liquidity. So 70% of the portfolio is completely liquid. Even the balanced portfolio has a amortizing structure where you get back 3 to 4% of the portfolio every month. So 75% of the portfolio is fairly liquid, and since we are selling it to, we are selling it only to people who understand this product, we are trying to have engagements. So to communicate the proposition very clearly and invite those category of investors who treat this as a core debt allocation. So we feel that on the liability side also, we can address this. So we intend to be fairly diversified from a liability standpoint, even from a per investor perspective or even a per distributor perspective. We want to be fairly diversified. Since we have a cap in mind, and like our founder said, at any point in time, we've got the independence to go to the board and tell them, sorry, we don't see enough opportunities. If you want to close the fund at 3,000, we have the independence. So we can always go to the board and tell them, not many opportunities, let's let's stop raising money. So they've given us the freedom. So we don't see both credit and liquidity becoming a challenge if we adhere to the scale that we have set for ourselves. Yeah, the way forward, I mean, at least from the next 1 year perspective, that you will not see many changes. Yes, there will be changes at the company level, but the allocation, we have reached a steady state zone that where we want to be, and so we expect the year 2 also to be similar. You will have a similar journey like year 1. And yeah, the standard disclaimer. And just want to end with a thank you and a quote from Tirukkural. The quote is, I'll read the Tirukkural first. Kundreri Yanaipor Kandatral Tan Kai Tondundraga Seivan Vinay. So what in our context, what it means is if you have a stability allocation, that is your safety net and insurance to tide over tough times. So especially when the Kural only means that if you want to watch two elephants fight, two mad elephants fight at each other, you rather watch it from a distance, preferably on top of a small hill, so that you don't get hurt, right? The whole point is to stay invested. So as our founder said, 15 years, I would say even rather 20 years, I showed you the data, it's 40x. And so that's how the journey should be designed. Thank you.
Hi, am I audible? Is everyone able to hear me? Thank you for that. Just a second, I just want to see that. Yeah, okay. Good morning, ladies and gentlemen. Thank you so much for coming here. I was speaking to some of you in the morning, and all of you have taken a lot of effort to come, clear your schedules. You've traveled from places, and you've come here to spend the morning with us. Thank you very much. It's very encouraging and very humbling as well. So firstly, thank you so much for that. As investors, we spend a lot of time analyzing financials, analyzing companies, meeting managements, building models. But every once in a while, I think it's worth stepping back and asking a bigger question. What kind of countries are these companies operating in? Because over the long run, great businesses rarely emerge in isolation. They are actually products of great economic ecosystems. And I believe today the global economy is undergoing one structural shift. And therefore, I'd like to begin by speaking to you more about that structural shift. Before we begin, a disclosure. I'm recovering from a sore throat, so if my voice sounds a little hoarse, think of it as market volatility. The fundamentals are very much intact. A new global order is emerging. For most of my investment career, I have grown up knowing one investment environment, and today I believe that environment is changing. The world is moving from a unipolar world to a multipolar world, from efficiency to resilience, from globalization to fragmentation, and from falling rates to probably rising rates. The world is moving from one dominant power to multiple centers of influence. For nearly 3 decades, the world prioritized efficiency, globalization, and low-cost manufacturing. Today, that order is changing. Businesses are optimizing for resilience. Supply chains are diversifying. Geopolitics is reshaping trade. Capital is no longer free. These aren't temporary headlines. They represent a structural shift in the way the global economic order is reshaping. Think of the world as a Formula One car. For the past 30 years, the objective was maximum speed. But today, the objective is to survive on a tough road. And maybe the fastest car is not the best suited car. And whenever the rules of the game change, countries with enduring competitive advantages begin to matter much more. This leads me to my next question. What really determines a nation's long-term success? History has showed us that countries become prosperous because they possess enduring competitive advantages, and they could be very different, right? So the Middle East had energy, Singapore had institutions and geography, Germany and Japan, for example, had manufacturing excellence. China, for example, has become the world's manufacturer. The United States had innovation, capital markets, and entrepreneurship. But one advantage amongst all of this stands out to me because it cannot be created overnight, and that is demographics. Because governments can build infrastructure, they can improve policy, they can attract investments. But they cannot create a large, productive working age population overnight. Demographic trends takes decades to evolve and decades to reverse. And that is why probably the French philosopher Auguste Comte said, demography is destiny. Now I want to ask all of you a question here. How many of you think India has too many people? Okay, thank you. Okay, perhaps. But the better question isn't how many people we have. The better question really is, how many people are economically productive? And economists have actually used a very simple framework which is called as dependency ratios to really give an answer to this question. It sounds technical, but it's really very, very simple. It answers two fundamental questions. The first question is, where will tomorrow's workers come from? And point number two, or second question that it answers is, who will support today's workers when they retire? The answer to the first question is the child dependency ratio, which is today's children become tomorrow's workforce. And the second line is actually the old age dependency ratio, which means that tomorrow's workers eventually have to support today's retirees. Right? And every country is broadly going through the same journey. First, you educate the children, they come to the workforce, and then you have to support the retirees. As you can see on your screen today, India sits in its most productive phase in that journey. But demographics is only potential. Employment creates potential into prosperity. So that really raises the next question, that can India create jobs for its growing workforce? Over the last 3 decades, India's growth story has been written in services. So we've had IT, consulting, software, financial services, global capability centers, making India one of the most leading knowledge economies globally. Microsoft, Amazon, Google, Meta, JP Morgan, the likes of them, they run their technology research ops from India. But services alone cannot absorb the aspiration of a country of 1.4 billion. And therefore, India's next chapter is not about replacing services, it's about adding manufacturing as a second leg of engine. And fortunate for us, the timing could not be better, because companies are today diversifying supply chains beyond a single geography, and India stands to have a significant opportunity. India's first growth story was written in code. Its next growth story may increasingly be written in its factories. Which then brings me to my next question, that what is the global opportunity? What opportunity does global trade have to offer us, right? And whenever I speak about this or I'm discussing this with people, it becomes very quickly about India versus China, right? And I per se think that's the wrong line of thought, because China can continue to be a very extraordinary, successful manufacturing economy. India's, opportunity does not depend upon China becoming weaker. It depends upon India becoming stronger, India becoming more relevant in global trade. And therefore, I want to show you some data here, right? Now, this data that I have presented to you, it looks a little overwhelming, but I'll just quickly walk you through it. It's very simple data. This data actually shows you merchandise export across the whole world, across India and across China. This is broken up into internationally recognized product categories, and we've taken broadly the 10 large export categories. What I want you to focus on is the 5-year CAGR. So as you can see, the global exports have grown at roughly 3% CAGR, China has grown at 7%, and India has grown at 6%. And looking at this data, all of us can broadly infer that India is broadly growing faster than global trade. So that's technically good, right? But growth alone isn't the question. The bigger opportunity is that can India gain market share? Today, India barely accounts for 2% of global merchandise export versus China, which is at 16%. To me, this is a measure of great headroom. When you control 16% of exports globally, every additional point is very difficult. But when you start at 2%, even modest gains can create enormous opportunities for businesses, jobs, and investments. And therefore, the opportunity for India isn't to export more, it is to become more relevant. And that begets the question that how can we become more relevant? Historically, India's strength has been in the labor-intensive sectors such as textiles, agriculture, and gems and jewelry. And these are enormously important sectors because they employ millions of people and they bring in foreign exchange. But successful economies don't export more. They export differently. They move up the value chain. And that transition is already beginning in India. We're seeing market share gains in electronics, chemicals, transport equipment, and medical devices. Electronics in particular is where India has doubled its market share over the last decade. And that matters because value-added manufacturing creates higher productivity, higher wages, and leads to long-term competitiveness. And this hasn't happened by accident. It has happened purely by design. The government policy has been increasingly focused on building competitive manufacturing ecosystems through the PLI, infrastructure investments, free trade, and global supply chain development. For perhaps the first time in decades, India's demographic, infrastructure, industrial policy, and global supply chain realignment are all pointing in one direction. And this is particularly interesting for an investor because when economies undergo structural transformation, value creation is rarely distributed evenly. A handful of industries emerge as disproportionate beneficiaries of this, and within those industries, even a smaller subset actually create enormous wealth. Countries gain market share, but companies capture the profit. And that is why, and that is where actually active investing steps in, and that is what we at Unifi do. India is a very, very heterogeneous market. We have thousands of companies, different industries, different stages of growth, different business models. Some of these companies will be major beneficiaries of these structural shifts, and some may not be able to be participating in this at all. And therefore, Our job isn't to be simply optimistic on India. Our job is actually to be selective within India. Now that I've given you how the construct is, I want to speak to you about the fund. The next few slides will talk to you about where we invest, how we invest, and why we believe that it works. Let's start with where we invest. There are broadly 6 long-term structural themes that represent enduring economic trends. The first is the investment in infrastructure cycle, which is being driven by public infrastructure, private capex, and energy transition. And this is helping a range of companies across industrials, cap goods, engineering, etc. The second is being globally competitive and export leadership. So India continues to strengthen itself as a manufacturing hub and services hub, and this is helping export-oriented companies which are of scale and focused on improving productivity. The third is Atmanirbharta on manufacturing self-reliance. The government incentive, private investments, we're all trying to accelerate domestic manufacturing in strategic sectors that matter. The domestic consumption and digital India, which is basically about rising incomes, urbanization, formalization, which is expanding the pool of consumption. At the same time, digital infrastructure is being created, and that is transforming the way how consumers transact and businesses operate. The financialization of household saving, the move from physical assets to financial assets, which is benefiting multiple intermediaries in the middle, banks, asset managers, wealth managers, intermediaries, brokers alike. And the healthcare and demographic opportunity, which is about favorable demographics, rising incomes, and improving healthcare access, which is supporting the growth for hospitals, for diagnostics, for pharma, and medical devices. Now that I've given you where we invest, I want to talk to you about how we invest. Our investment process has simple principles. The first principle is to respect the benchmark, because that is where a lot of the market really resides. The second principle is to generate alpha through active bottom-up stock picking. And this could be in smaller parts of the index or even outside the index. And the third part is to never compromise on our valuation discipline. Growth matters, but so does the price we pay. And therefore, this balance between active benchmark mindfulness, active stock selection, and valuation discipline forms the foundation of every investment decision we make. Structural opportunities aren't emerging in any one corner of the market. They're not confined to market cap segments. A flexi cap strategy really gives us the freedom to invest where we believe the best risk reward is actually possible. You will notice that our portfolio has meaningfully evolved since the fund's inception 13 months ago. During the tariff-related uncertainty, earnings visibility had deteriorated and small and mid-cap valuations had remained elevated. We therefore leaned into the relative resilience of larger businesses. As markets corrected, valuations became more attractive, we increased our allocation to small and mid-caps. We weren't reacting to headlines. We were always responding to the opportunity we saw. And as opportunities really emerged, so did our sector weights. You will notice that our exposure has meaningfully increased in areas where we believe that the long-term prospects have materially improved, and we've reduced allocation where valuation or risk reward has become less compelling. And so has our allocation increased to names outside the benchmark. Because some of India's most attractive businesses are simply not being represented enough in the benchmark. A genuinely active portfolio must be willing to look beyond the benchmark. And while doing all this work, a lot of times people have this question and they keep asking us, why don't you take cash calls when the markets look expensive? The answer to that is very simple. We don't believe that anyone can consistently predict the markets. And history has shown us that if you miss the top 10 best trading days in the last 26 years, your returns are actually less than half. And that is why we focus on what to own, not when to own it. And that's why you'll see that the cash levels have broadly been in the 2 to 3% level all across. That brings me to our active share. Quite simply, active share measures how different our portfolio is that to the index. A low active share means that your portfolio is mirroring the index. A high active share means you are, doing a lot of independent research and you're taking high conviction calls. And as you can see on your screen, that our active share has been 60% or higher across the life of the fund, and it's only been growing. I want to say here that we don't aim to be different simply for the sake of being different. We're different because our research is actually leading us to different conclusions. And if you actually open your fact sheets and see the largest position that we have in the fund today is a non-index, very high active call that we have taken. So actually the fund is really telling you about, and if you look at the fact sheets, it's an actual reflection of how active we are as a fund. And one of the reasons we're able to take these active calls is because we lay a lot of emphasis on governance. And governance is often underappreciated during bull markets. But over the long period, it becomes a good differentiator for investment outcomes. In a country with thousands of listed companies, governance is not a filter for us. It is the first line of defense. We believe that the quality and integrity of the management is as important as the quality of the business. And a lot of times people ask us that, how do you really judge governance, right? We don't rely at all on instincts. We've built an internal governance scorecard, and this scorecard really assesses companies across several dimensions, right? So it takes into account capital efficiency, business model, the promoter, the management quality, executive compensation, other activities, the disclosures, the quality of the board, the executive team running it, a lot of things. Each company is then given a weighted score. Therefore, this process allows us to evaluate governance consistently and objectively. Because governance can be qualitative, the process of assessing it should be rigorous, structured, and repeatable. Our investment philosophy. The world calls our investment philosophy as CARP, or growth at reasonable prices. I think it's actually a very Indian philosophy. The reason I say this is because as Indians, whenever we go to make purchases, we typically ask two questions. The first question we ask is, Acha hai kya? Or Nalla irukuma? Or is it good? The second question, instinctively, which comes out next for us is, Kitne ka hai? Enna vilaya? How much does it cost? And these two questions actually matter in investing too. As Indians, we want the best quality. But we also want to feel that we've negotiated well. We don't want a bargain that falls apart in 6 months. but we also don't want to overpay for it. Right? This is how we are. This is exactly our investment style. We want an outstanding business, but we also want to pay a sensible price for it. This slide actually captures our investment philosophy in numbers. What you'll be able to see on your screen is that our portfolio is delivering return ratios and earnings which are slightly ahead of that of the market. We are paying a slightly lower multiple than that of where the broader market is. And this is all represented in one number, which is the price earnings growth multiple, which is called as the PEG ratio, where we are better than the index. And this is actually a reflection of our GARP approach. Our objective is fairly simple. We want to own high quality business with strong prospects, but only when there is a very attractive risk reward opportunity from a pricing perspective. Why do we believe this works? Ultimately, it skipped, Ultimately, it seems to be running ahead, like markets sometimes. Okay, so ultimately, investment philosophy should not be judged on how they sound, but how they perform over time. We believe that our disciplined approach has enabled us to generate consistent outcomes over the life of the fund since we have launched 13 months ago. Rupees 100 invested in the index would have been broadly the same, and the same 100 invested in the Flexi Cap in the direct and regular plan would have done 105 and 103 respectively. A question that is naturally there on all our minds all the time. What kind of returns can investors expect over the long term? As I close, let me tell you a personal story. It was 1st of July 2021. It was about 9:30 in the morning. I had been at Unifi barely for about 5-6 months at that time. I was a part of the PMS and AIF team. As was the scheduled morning routine, I would talk to Sarath sir in the morning, and I was having a conversation. I can't remember what exactly the conversation was, but he said some words at that time that have stuck with me. And I remember those words very vividly. He told me, Aejas, never forget that the work we do represents someone's lifetime of hard-earned savings. They have chosen to entrust it with you. Treat that responsibility with the seriousness that it deserves. I have never forgotten those words. Markets will rise, markets will fall. Investment styles will be in favor, investment styles will go out of favor. Every investment we make, every risk we take, every risk we avoid taking is guided by this one thought, that we are not managing numbers on a screen. We are actually managing the hard-earned saving and aspiration of people who have placed their trust in us. If there is one thought I hope you take away today, it is this. The world is changing. India is changing along with it. Those changes will create extraordinary businesses. Our responsibility is to find them early, to diligence them, to value them sensibly, and then to remain patient so that compounding can do its work over a period of time. Thank you for placing your trust in us today. It is a responsibility we never take lightly. Thank you.
Thank you, Aejas and Saravanan, for taking us through the fund details. That brings us to the last session of the afternoon, for which I request Mr. Maran Govindasamy and Hari Viswanath onto the stage. Thank you, everyone, for giving us the time and the patience to sit through these. And that, as I said, brings us to the last session of the afternoon. Let me just do a quick introduction of the two speakers, and then I'll give the context to the afternoon. Mr. Maran is the co-founder and executive director of Unifi Capital. He's also on the board of the AMC Trustee as representatives of the sponsor. Mr. Hari Viswanath is the editor of Research Bureau of Hindu Business Online.
Thank you.
The Research Bureau publishes the popular Sunday edition of Business Line called BL.Portfolio, which is focused on stock markets and personal finance. Hari has about 2 decades of experience tracking US and Indian markets, having previously worked as an analyst for a US hedge fund. At Business Line, he usually writes on global markets and macro fundamentals and broader topics of investing. Thank you for spending the afternoon with us. So I'm just going to give a little context. So today's discussion is on asset allocation, and sometimes in these days slightly overused. But we feel that in current volatile markets, asset allocation is, I think, probably the only thing that you can fall back on. And Unifi Capital for the longest time, or even till now, has been an asset manager. So they have equity products, they have fixed income products. They've never put the two together and created a product that asset allocates. But however, Mr. Maran, for the last 14 years, has been writing an asset allocation note in one of the local vernacular newspapers. And I'm sure everyone who has read it has benefited out of it. So we thought, what better way than to put it into some charts so that you can understand the journey instead of backtesting some data which was just theoretical. So these are actually notes that he has published every Jan for the last 13 years. And what we've done is we've looked at how those portfolios would have done over the last 14 years compared to some of the asset classes. So that is one part of the discussion. The other part of the discussion is I'm sure Hari will ask some tough questions to Mr. Maran to give you some perspective on the various asset classes and their prospects going forward. Over to you. Thank you.
Thank you, Josh. I can say, having known Mr. Maran for quite a while, there is no question which is tough for him. I mean, he is like Gemini before AI was launched, actually. So.
Can you hear me? It's audible now? Yeah, thank you. Thank you. Thank you, Hari.
Thank you, sir. Thank you, everyone, for joining us. As I said, it's my privilege to be on stage with Mr. Maran, whom I rate very highly. I think if you have to filter people in our country who have the best knowledge on stock markets and economy, Mr. Maran is right up there, actually. So it's my privilege, sir. Thank you. So today we are going to discuss asset allocation. It's a concept that I believe in very strongly. I wish I had believed in it 20 years back when I started my career. So it's like, so I think if you're young out here, take it very seriously. Asset allocation is probably the best way to reach your financial goals. So we've all heard of this 4 most dangerous words in investing. This time it's different, all right? And something that I coined is, no one saw this coming, which is what anyone says after a market crash to say, to escape responsibility. So there are a few more dangerous words in investing. How do you counter n number of dangerous words? The 2 best words to counter it is asset allocation. Okay, so with asset allocation, you can deal with any volatility in markets as long as you do your asset allocation right. So in this context, I would like to share a real conversation I had with a cousin of mine just last Sunday. Okay, so she and her husband live in California. They work for technology companies there. They have 2 kids, early teens. And so Sunday we started talking, and she was asking me some doubts on US stock markets. And in that conversation, I was asking her about her financial planning. And I was kind of shocked. She's 45. All their liquid savings are in equities. They have a nice expensive home in California where real estate is very, very expensive. But all their financial savings are equities. And when I asked her why, I mean, isn't it risky? I told her it's extremely irrational, especially for somebody who has a family. And she said, in California, the culture is that most of your salary is in stocks. You're predominantly paid in stocks. The high cost of living there means most of your, if you have a family, most of your the money that you get that gets credited into your account mostly gets spent for your living expenses and maintaining your lifestyle. So if your savings for the rainy day, for kids' education, their retirement, it's all in stocks. And the other thing she said is, so they're paid in stocks. And then the second factor she told me, she said, every single time they have been investing, which is like around 2006-07 when they got the ESOPs, markets have always recovered. They're like, either like we've had the global financial crisis, central bank stepped in, government stepped in. Then we had Eurozone crisis, again central bank stepped in. COVID crash, it wasn't even a crash in my view, because if you hadn't seen market for 1.5 months, you wouldn't have noticed anything. Then you had the crash, Russia, Ukraine, markets again recovered. Then you had tariff-related crash, and this Iran, Iraq. All the Indian markets are below their peaks. Most global markets are at their peaks. So their experience has been amazing. I mean, it's been flawless. Okay, so I was losing the debate. I didn't know how to convince. I felt like what any value investor has felt in the last 15 years. It's like you find it difficult to make your point. And then I asked her one question because she was leaving the very next day. And so I asked her, if I offer you a flight ticket at 50% of the price that you paid for, but the plane will have only a single engine, so you'll have to fly over the Pacific Ocean on a single engine plane, would you do it? She said no. So basically that is asset allocation for you. It's like a plane with 2 or 4 engines. You can travel the world, sit in the business class, enjoy the wine and the fine dining, and you'll reach your financial destination safely. So that's what I wanted to say. So, sir, since you've been writing on this for a long while, can you explain how you approach it? And especially, I have some specific questions also, but I saw that in the article that you've written over this period, your timing has been quite impressive for me. It's like you said no gold till 2018, and then you said allocate to gold in 2018. You reduced equity allocation in 2024. So if you can share how you approach it and explain it to us.
Before that, I'll also brief why this Tamil vernacular. When you spend more than a week to prepare something, why not publish in mainstream media? I invited my friend who works in Vigadan, Ananda Vigadan. And that's the only magazine my mother reads. So I found this is the ultimate way to impress her. There's no other way you can impress her. You can't tell I manage this much capital, this much investors. But the moment she sees the New Year edition with the cover story, and how much ever I try to tell him don't take photograph, don't put, each year he takes some new posts and puts, my mother easily got impressed. So that we started in 2013, which is just around the time we started our fixed income practice also. 2013 was a tough period in the sense, I don't know how many of you noticed, index in July 2013 was at the same level where it was in Jan 2008. 5.5 years of no return, I don't know how many of us can live through, but people lived through, which is when we felt there is a need to have an alternative, at least for a portion of the capital. The answer can't be that Unifi can be an answer to your portfolio only through equity means. And if we need to look beyond that, fixed income obviously is a choice. You can't say ignore real estate because that's where more than 2/3 of household savings in India is invested. And you just can't ignore gold, which is principal mode of saving for several millions of households in India. So you have to have a view, whether you like it or not. And just around that time, 2013, the previous 5-year, in fact, previous 10-year rally on gold was very, very sharp. So sharp that mutual funds started offering gold schemes. It's the ultimate sign, right? How do you pick a peak in any asset class? Just see the fund offerings of mutual funds. If the NFOs pile up in one category, you know it is peaking. And 2012-13, you had not one, two, series of schemes coming in which denominate in gold. So we started writing. And it was a very hard decision to write in 2013 allocating a zero allocation to gold. And 2013, gold was probably the best performing asset class over the previous 1 year, previous 3 years, previous 5 years, previous 10 years. And to advocate a zero allocation at that point of time was a tough decision. But we even prepared a 20-page note on gold. Are you buying gold? That's the title of the note. And we even printed thousands of copies and went around, shared with people, saying why it makes no sense. Because the perception on which people took decision to buy gold was all weak. And they were all changing, which people didn't notice. So that journey, but in 2018-19, after 6 years of zero return on gold, and those 6 years, other asset classes did exceptionally well. When that's the time we were suggesting to begin investing in gold. The 2024 was an easy decision, especially if you look at, maybe I'll ask my colleague to shift
slide
these
can-
to slide.
This one.
If you look at the
7.
slide number 8.
8.
Yeah. So 2013 when I wrote, it was about 14. Each year when we write, we don't write for that year. We write for taking a 3-year outlook. Of course, we write each year, but each year is for the next 3 years. What is the logic? The logic is when you narrow frame your attention to 1 year, sometimes you give disproportionate importance to current events and ignore the discipline of rational valuation behind each asset class. So the yellow line is how gold moved between 14 to 16, and during that time our allocation to yellow line was 0. And today people find it hard to accept that gold can move negative returns for 3 years, sometimes 5 years, sometimes 6 years in a row. I don't know how many of you know, between 1991 till 2002, gold was at the same price. Not in US, in India. If you take in global markets, it was down 20-30% due to currency depreciation. At least it was stable here. So taking a view on asset allocation doesn't mean you have to tinker with it every month or every quarter or even for that matter every year. So if you do it once in 3 years with very unbiased, unemotional, and based purely on rational, on the valuation basis, it will give you tremendous clues. So before we start our conversation, I just want to give you a sense of how different asset classes moved in different time periods. So 14 to 16 gold was at the bottom, whereas fixed income would have been on the top, right? And 15 to 17, you would have seen some equities doing well, gold just inching up. 16 to 18, actually it is very tough to put a number for residential index, the real estate index. And there is no such thing called India real estate, because real estate is extremely localized market. Bombay real estate is very different. Between 14 to 16, actually Mumbai real estate more than went up 60-70%. Bangalore would have struggled. Hyderabad would have been down. Chennai was average. So it's extremely regional market. So we took help from the National Housing Bank residential index, which plots state-wise and sometimes region-wise, and it also plots over a period of time. Thereafter, it became a paid site. We still incurred some cost to get this data. It averages to about 10-11% per annum. That's all. Many people think, you may hear few stories about people saying, I bought this piece of land that went up 10x in this year. Recently, in social media, people talked about 1,450 crore bungalow being bought in Lutyens Court in Delhi, which was just bought for 350 crores 12 years back. But if you actually do the IRR, it comes to only about 11.5% per annum. Even Uday Kotak mentioned how he bought in 1981 an apartment in NCPA, and recent transactions was happening at almost 50x that value. But if you convert that into an IRR, it is only about 10.5-11% CAGR. So you may find different asset classes moving in different returns over a 3-year period. If you shift to the next slide for the recent numbers, 22-23, you might have seen equities fantastic return. That's something like 20%, 23% kind of return. But when you have 23-24% CAGR over a 3-year period, usually that's the investor's tendency is to maintain what they already have and probably add even more, which is exactly a time one should be cutting. In fact, even though I have been writing since 2013, only after COVID, 2020, I was even suggesting people why you should cut your equity into 2 parts and expand the small cap, mid cap almost by double. That's a great opportunity. That's the only year I wrote asset allocation twice. We wrote in January, as we always do each year, and we wrote one in June 2020, why you should double your equity exposure, and what you double should more of be in the highest end of the risk, which is small and mid caps, right? But 2024, it was an easy decision for us to advocate that cut and shift that money into a fixed income. And similarly in real estate, even though we had zero allocation, if you come to the slide 6, what you will observe here is 14 to 18, 0 in gold, 0 in real estate, significant in equity, and equity was one of the top performing asset class post Modi ji becoming Prime Minister. And in 2021 is when we were increasing allocation to real estate. In fact, 23 we increased it again further. So one thing you will notice is across these 12-13 years, the total number of decisions we would have taken to get the decisions that got reflected in the asset allocation table would not have been more than 6 or 7 across 13 years. So what it means is you don't need to do more than 1 or 2 changes once in 2 years. So that's the background which I thought I could share before we take questions.
Yes, sir. So one thing I found interesting in your articles was you have a conservative, moderate, and aggressive investor. You recommend asset allocation according to individuals' approach. And I see that when you say aggressive, it is not just in equities, in gold also. So number one thing before people get into this is they need to understand themselves. Most investors, which was my experience early on also when I started, and I believe most are like that, you think you can handle a loss, but when you go through the loss, you are not that person whom you thought you are, right? So how does a person, before getting into allocation, understand who they are and what to invest? Whether they're moderate, conservative, or aggressive?
It's not that easy. There is no mathematical formula that you can apply. Some of our friends in banks think they can do this by spending half an hour with clients in evaluating. It's not that easy. But what is easy is we can ask the question in a very indirect manner, right? Each asset class, we use the term standard deviation. to measure volatility, right? Thanks to the social media and lot of investor education programs, everyone knows Nifty was set up in 1994, and since then till now it has done 13.5% CAGR. Sensex was set up in 1979, till now it has done 15% CAGR. Return numbers people understand, but they don't realize the standard deviation. If you ask them what is the standard deviation of this return, first of all they ask what is standard deviation, and then they ask what is its relevance. So when someone says Nifty has done 13% per annum since inception 1994 till 2024, over 30 years, it's not that Nifty delivered 13% each year. There are years like 2008 it did almost minus 60%, and there are few years where it has done 40-50%. But one standard deviation, which means 2/3 of the time, out of those 30 years between 94 to 2024, 20 out of those 30 years, the index was about 23% away from that return line. That's standard deviation. So Nifty delivered 13% per annum with 23% standard deviation. During the same period, the fixed income would have given maybe 7-8% per annum with the standard deviation as good as 0, maybe 1. Basically what it means is, to earn 5-6% higher return than what fixed income offer, an investor is expected to undergo 23% volatility. If you highlight this in a language the investor understands, that will help them to understand whether I can tolerate 23% standard deviation. If they say I can take 5-10% standard deviation, that will help you what percentage of your portfolio can be allocated to this. So it's basically working reverse. So instead of asking a question so bluntly, which relevance of that they may not be able to comprehend, and they don't know how to answer. It's not that their intent is not to answer, they just don't know how to answer. But if they have 100 rupees and they say the worst that they can take is 10 rupees, then but you know 2/3 of the time this asset class can give you minus 25, then you put a number saying that equity should not be more than 20, 30, 40% of their portfolio. That's how aggressive, moderate, conservative can take. Many people confuse that with age. Thank you. Many people confuse that with age. Quite often we make that mistake. We tend to think people in 20s, 30s can be super aggressive, but people the moment they get into 60s, 70s should be conservative. I took a long time to realize that age has nothing to do with this. There are several people I know who are aged 60 and 70 who are not going to live out of that wealth. They are going to pass this wealth to the next generation. Actually, they can be as aggressive as possible because they actually have longer time period in their portfolio than the guy who is at 30, 40 who has immediate cash flow requirement, either to buy a house or to pursue higher education or to fund the family expenses. So age and asset allocation has no correlation. So the nature of conservative or moderate or aggressive is more a function of the investor's perception of risk and their tolerance of the volatility.
Here I'll just share something that happened at Business Line. So we get mails from our readers because we have a section that answers readers' queries. So a year back or so, I got this mail. I'm 75 years old. I have 3 crores in the stock market, 80-90% in equities. I want to get into derivatives, suggest strategies. we told him, please don't do this. So that's what markets like. You have like a amazing bull market where all dips are are bought. That's the kind of confidence it gives you actually. So coming back to the aggressive conservative thing, what about people should also consider their family circumstances. Like one person might not have dependent parents, another person might have dependent parents. So these beyond one's individual ability, they should plan for these. So
absolutely,
this also should factor, right? Okay.
Absolutely.
So the other thing I wanted, so I'd gone through the graphs, and when you were showing it, so everywhere I see the asset allocation line comes second across most years. So it reminded me of this scene in Mannan movie, Rajinikanth, right? When a journalist asks him, your wife is number one, you're number two, which is big? Rajinikanth says he's number two, but says two is bigger. So coming two in asset allocation is better than coming one in equity. So that's the...
See, coming one is not the objective. If you follow, say, there is no such thing called perfect asset allocation, but let's say there is something called perfect asset allocation, and you follow that, what is your intent? Is your intent to be top of the return chart each year, every year? That's not the intent. The intent is to make best of the choices which are available, right? So if you follow this table, if equity has done, say, 12.5%, but it had to endure a 20% standard deviation, who is a good fund manager? My definition of good fund manager is someone who achieves higher return by assuming same level of risk, or someone who achieves same return by assuming lower risk. You should deliver one of these two values, right? Some of us who focus only on the return in isolation, in a separate silo, ignore the element of risk what he took to earn. If he had taken disproportionate amount of risk to earn that 5% extra return, the risk is eventually going to come back in some form and manner when you least expect it. So in our intent here is not to be, the asset allocation line would not have been top of every other asset class every year. It would not have been worse than every other asset class every year, right? If equities can deliver, let's say, 12 to 15% per annum, and gold can deliver, let's say, 18% per annum, but that 18% per annum comes with zero return for 7 years and 150% in 2 years. Is that how you are going to make your long-term investments over 20, 30 years? If you are doing that as a jewelry purchase and you ignore the price and act, that's different. But if you are doing financial investments and use asset allocation as a tool to make those decisions over a long period of time, the intent behind asset allocation is to deliver a return which is commensurate to the top tier, the first tier 1 kind of return, but not assume the risk that tier 1 takes. If equity can deliver 12-13% return with 20% volatility, and if our asset allocation table can deliver maybe 1% less than that equity return, which is around, say, 11-12%, but with less than 5-6% volatility, it adds value. So the asset allocation return will never be top of the table. It will, of course, never be in the bottom half of the table. It will be very close to the top. But the beauty of that is more reasonably seamless, low volatility line. Yeah.
Yeah. We go to slide 12. Yeah. So the question, I have a question whether, because your fund manager also said we are now entering a changing world order, a new regime globally. So is there a case to aggressively modify asset allocation mix compared to, for example, in the last 12 years, your average asset allocation to gold is 7, although now it is 15%. Equities is average is 56, now it is 50%. So the reason I'm asking is at Business Line, a few months back last year, towards the end of last year when gold was rallying, we did this analysis on historical trend of gold, that 5.5 decades of gold's performance. So if you see 1971 to 1980, massive bull market for gold, 15x returns. S&P 500 through the whole decade was up only 47%. US had high inflation. The central bank faltered in by cutting interest rates too early. And gold in INR, what we have taken is This is not the actual India price. We've just taken the global price and multiplied it with the currency, change in currency. So this will not have impact of taxes. Like if we increase taxes, the INR price is a theoretical exercise till it started trading in MCX. So what we have is great decade for gold. 1981 to 1990 and 1991 to 2000. Terrible year for 2 decades of terrible years for gold. My understanding when I worked on this article was that the reason gold had a terrible decade in 1981 to 1990 was Paul Walker. A central bank chief, he crushed inflation. He triggered a recession to crush the economy, to convince people that I'm serious about controlling inflation. If you're going to have 6 bad months, job losses, cut in profits, I'm fine with that, but I want people to be convinced that after 10 years of high inflation, inflation expectations being high, I'm going to crush inflation. So to me, that is my understanding. Paul Walker was the single reason inflation got crushed. Because of that, US had 2 decades of very low inflation, 1980s and the 1990s. S&P 500 had a great decade, like 143% returns. And then 91 to 2000, again, although your point is correct on gold in India being flat, globally down, in India being flat, ours shows 83 because it's a theoretical exercise. We just converted into the currency exchange rate. So broadly, then 2001 to 2010, again, the table shifted a bit where inflation started coming back, which is why they started rising interest rate during dot-com boom. That kind of made the bubble unviable and stocks crashed. Then they again reduced interest rate. Then they started increasing by till 2007, which resulted in the collapse of 2007. So then again, gold had a pretty good decade because monetary. Actually, if you see between 2000 to 2007, gold movement in dollars was minimal.
Yes.
Much of the movement of 422% that you see here in the chart was from 2008-7 onwards, basically, because the economy was heating up. Then uncertainty came in, money printing exercise started, central banks, quantitative easing, etc. Gold did well. Surprisingly, 2011 to 20, gold didn't do too well. The reason being inflation was somehow, elusive. Like central bankers were wondering why there is no inflation. They were trying to trigger inflation, but they just could not cause it actually. So there is a deflationary world. And but then now 21 to the current decade, starting Jan 21, seems to be a little bit like the 1970s to 80s because inflation has been very high. If you see the average inflation, the average CPI, which is in the table at the bottom, you can see that it was 7.86 in the 1970s. Then it was trended down till 2010 decade. 2020s, it's 4.56 so far, this decade so far. So inflation is high. Now again, we are looking at higher inflation due to, surprisingly, not just crude, but memory chips also. We are calling it AI inflation. So inflation appears to be back. At the same time, governments have been very irresponsible, Western governments with massive fiscal deficits. Like if you see in the second row in the table, US fiscal deficit has been averaging close to 7%. Even if you take off the COVID stimulus, it's very high at 6% today. So they're literally printing money to keep the economy going. Central bank balance sheet is also high. So this is on one part where, and then geopolitics, right? 91 onwards, it became a unipolar world after Soviet Union collapsed. And it eliminated majority of the global threat actually. So one more reason why gold didn't have a good decade in the 1990s. Now we are having the worst geopolitics in the last 30-40 years. And it's not, there is nothing which is happening which is convincing me things will get sorted out. It is the Russia-Ukraine war is going on. Europe-Russia relationship is deteriorating. Now we have the Middle East crisis. Trump is kind of making it tough with every country is trying to make them his enemy. So geopolitics in my view is getting tough. China is rising. So this is one reason I'm asking whether we stuck to a 10 to 15% gold allocation in the last 20 decades. Should we now look at 20 to 30%? That is one question. Then the other question is, if we can have the next slide.
Next slide.
So we also did an analysis on the Indian markets. On this, so if you see the net profit margin, we did this last year end again. So we have taken till June 2025. It's a 6-year period from FY19 to FY25, where Nifty profit margins increased for Nifty 50 7.5 to 11.1%, and for Nifty excluding financials from 7.8 to 10.3%, the net profit margin. I think we have maxed out on our net profit margin, because in the last 6 years we had corporate tax cuts, which alone gave a 15 to 20% boost to, or at least 15% boost to corporate profit margins. And then we've had government stimulus, and then we've had formalization, where a lot of shift has happened from informal sector to the formal sector, in which are Nifty companies. So when let's say I did an analysis for FY19 to 25, and I saw what would have been the growth in profits excluding if profit margins had stayed flat, which means henceforth your profit growth is directly linked to your revenue growth. If your revenues grow, your profits grow. Otherwise, it doesn't. It would have been 61% for Nifty 50, and it would have been 68% profit growth over a 6-year period for Nifty 50 excluding financial. So here you are looking at assuming from here margins cannot improve. Let me know if you think margins cannot improve. My view is it may not, because one, we've had all the tailwinds in the last 6 years. For margins to improve from here, like US is one of the few countries which are seeing margin expansion, that purely because of AI. All their chip companies and their AI company, I mean, the big techs are seeing massive increase in profit margins. So we need innovation in AI if our profit margins have to increase. So that is one thing. And then, and then the second thing is, if you see the bottom chart, which is on US 10-year government bond yields, like the shaded part is when global bond yields were very low, which resulted in lot of FPIs coming into India, because they're getting 0 to 1% on their bonds. Even a 70, 80 P stock in India was cheap. But now you have US bonds at 4.5 actually. So our market is less attractive to FPIs relative to cost of risk-free rate in the US. Our margin expansion appears largely done. Our PE is not cheap. So in this context, is there a case to increase, because of the earlier point I made on gold, whether should we get a little bit more aggressive on gold and little less aggressive on equities?
So basically, my understanding of what you mentioned are 3 things.
Yeah.
One is gold did exceptionally well in 1970s.
Yeah.
Something similar will be seen now because of geopolitical issues, and therefore should we increase allocation to gold. Second is, last 6-7 years earnings growth mostly came from margin expansion and retained yield. That may not exist anymore in future, and therefore should one reduce. Third is, if interest rates in general are rising globally, it can also have its own impact, either through FIIs or through whichever manner on equity. We don't have short answer for each of them, but in all these several minutes of your talk on gold, you missed the most important.
Nixon thing, is it? Gold standard.
The white elephant in the room most people miss is who bought gold from 1971 till 2020s.
Okay.
36% of the gold bought from 1970s till 2020s were Indian households.
Oh, okay, okay.
The average gold mined from last 30 years is averaging close to 1,000 tons a year. It didn't go by more than 10-15%, didn't decline by more than 10-15%. And many people still think South Africa makes most of the gold. Actually, it's China.
Okay.
China is the largest producer. Indian households are the biggest buyers in 90s as well as 2000.
Okay.
The recent years, 5-6 years, the biggest buyers are central banks. While both of them either of them buying may have similar impact, but both are completely very different types of buyers. A central bank buyer is a future seller.
Okay.
A household buyer is not a future seller. Right? 85% of the gold retail in India is jewelry, and that never actually comes back.
Okay. So the supply is, it will never pressure the market later.
Yeah. For example, 1991 till 2001, when gold moved nowhere for almost 10 years, globally in dollar terms, actually declined. Who was the biggest seller those 10 years? Central banks.
Okay.
Between 91 till 2001, the biggest sellers of gold, not 1 year, 2 year. 8 out of 10 years, the biggest sellers of gold were European central banks.
Okay. Okay.
Why? Because the reason they bought gold in the previous year no more is valid.
Okay.
So, based on the nature of the buyer, you can determine whether an asset class is a trade or an investment. Many of us in our market, we sometimes confuse this word with trader with investor. Some people say short-term investment of 1 week, 1 month. That is not investment, that's trading, right? What is the difference between a trader and investor? Let's say this is worth 10 rupees and I have a method of calculating how much it is worth based on the plastic, the water, the packaging, retail. And if someone sells it to me for 3 rupees, as an investor I will use my understanding, my knowledge to make a valuation of it and then buy. When I buy it at 3 rupees, I am not going to answer the question of to whom I am going to sell and at what price and when. Eventually one day I may sell, but the drivers driving my buy decision is how much it is worth and what is the price I get the commodity. That is investor. A trader is not like that. Even if he knows that this is worth only 10 rupees, but if he is confident of selling 20 rupees because of scarcity or various reasons, and if he gets this at 15 rupees, he will still buy, because the factor which is driving his decision to buy this at 15 rupees is influenced by his confidence to sell it at 20 rupees. So a trader action is very, very demand supply driven, very narrow framed on short periods, and his buying always is coupled with a sale, maybe a year from now or maybe a month from now. So at best gold is a trade, maybe a good trade, not a good investment, if the reasons based on which we buy are these reasons.
The geopolitics and all that. Okay. Okay. Okay.
So if you think you are a good trader and you track it and you know when to get the signal to sell, then you should buy more of gold.
With this trading scope, let's say it can be, do you think there is room to break away from the traditional, which has been the concept that 10 to 15 has been the norm? Do you think it can, for example, Morgan Stanley last year for their US investors, they made a structural change they usually had a 60-40 portfolio, 60% in equities, 40% in debt. They changed it to 60-20-20, which is 60% in equities, 20% in debt, because US, there was pressure on US bonds also. And then they said go 20% into gold. They said,
yeah, it's normal for some of these reports to come when the gold is
doing too well. Okay.
But if our asset allocation intent is to diversify, the room for gold available could be maybe 15% now.
Okay.
It could be maybe 20, it could be 10, it could be 0.
Okay.
But it's not going to be
25, 30 and all that.
Certainly not.
Okay.
And we don't think with the factors and the news and the information that's available, you can predict a 10-year, 15-year visibility and take a call just based on some of this.
Okay.
I think the biggest factor which people are ignoring to look is if 35-36% of the global demand came from Indian households, those Indian households, today 2/3 of India is aged below 34. Half of them are women. Women in 20s, 30s are not buying as much gold as women in 20s, 30s bought in the previous 10, 20, 30 years. So the jewelry demand of Indian households has been declining. Some people attribute that to the price. Because price went up, they have bought less or they are buying, they are not buying. But I don't think this is nothing to do with price. For example, between 2020, 21, 22, when travel was rising, people are linking that with COVID, saying that it is revenge spending, it's post-COVID exuberance on travel, this will subside later. But it went on increasing because the travel increase post-21, 22 has nothing to do with COVID. It was more a function of demography, income levels. Similarly, in gold, the demand decline in households, which we have been seeing now for almost 7-8 years since 2017-18, is partly to do with price, but mostly to do with the urbanization, the changing demographic profile, and this is unlikely to change in the next 10-15 years, and there is no, therefore, strong case for overweighting gold for 10-20 years based on the recent development.
Trends, okay.
With regard to equity, the margin helping profitability increase and therefore valuation increase, it's a seasonal stuff.
Okay.
We will review it.
Okay.
We have been reviewing it every 3 years. But what all our historic analysis don't take into consideration is when you narrow frame your attention to Nifty,
Okay.
and that too Nifty X financials, and financials is 35-40% of Nifty. What are you looking at? You are looking at other just 4-5 sectors.
Okay.
Which is what is counterintuitive is our indices are very fast evolving. When I began my career in 91, if you take Sensex, top 30 companies, you would not have found a single bank. You would not have found a single IT company. You would not have found a single pharmaceutical company. Probably 20 out of 30 Sensex companies were steel, cement, power, textile. Right? In 2001, ITA was 40% of the index, 40% of India's market cap. Right? In 2006-07, real estate infra, they became large part of the index. And 2021, it was financials became 40% of the index, which didn't even exist in 91. So 10 years from now, you may find different businesses coming into Nifty,
Okay.
and those businesses' return characteristics could be very different.
Okay.
Return on equity could be very different. Shareholder return could be very different, which means there is a room to stay invested in equity, and this is our decision to overweight, underweight should be driven by the valuation range,
Okay.
instead of doubting the profitability range. That way, I think this is not a time to be underweight on equity, but the time to overweight on equity should be driven by which segment of equity you are overweighting. In the last 2-3 years, not necessarily with this context, but in general context, what you would have noticed is you may find extreme divergences the equities market have delivered. There are few managers who have done 25-30% per annum. Right? There are few managers who couldn't even maintain capital. There are few who have delivered negative return. Same way, if you take the same NSE 500, the top 500, which is 90% of India's market cap, in the last 5 years, you would have seen hundreds of stocks going up 100-200%, and there are also hundreds of stocks which are at the same price or lower price. So this divergence, if you have the capability to understand and make your portfolio changes, you still can maintain a overweight on equity if you are in the value on the side of the market. But if you are betting on only those businesses which have done exceptionally well in the last 3-5 years in price and not so well in earnings, there may be room for disappointment.
Okay.
So your overweighting equity or underweighting equity may not have to be influenced by the Nifty,
Okay.
but it's influenced by the kind of equity that you own today.
So when you say equal weight equities would be 50-60% of your assets.
Absolutely.
Okay.
It should continue to form part of
Overweighting means going above 60%.
Yeah.
Okay, got it. Okay.
the case to overweight should be driven by attractiveness in valuation.
Okay, okay.
And that existed in
Like you had in
during COVID time.
21 and 2017 you had 70% allocation.
Absolutely,
Okay.
absolutely. Those are all extraordinary situations
Okay.
where one can go even up to 70%, like in COVID, like in 2017. But at a time like 2024, when you are running at 3 times in 5 years kind of return, you should scale it down.
Okay. Do we have time or are we done out of time?
Yeah. So
Thank you very much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.